The economy around the world has not been going well for quite some time now. Inflation has been a problem globally. Many countries are suffering the brunt of it. Yet, what is it that is spurring all these economic hardships? Chamath Palihapitiya seems to have the answers. Chamath Palihapitiya has predicted that buyers must be careful when investing their money in the market. He indicated that this could be the most significant crash that the world has ever seen. Why does he say so? Stay tuned till the end to find out. Today we will talk about the new statement from Chamath Palihapitiya, who says that buyers need to be careful. This is because 2022 will bear witness to the most significant market crash in world history. Chamath Palihapitiya is a Sri Lankan-born Canadian and American venture capitalist, engineer, SPAC sponsor, and Social Capital's founder and CEO. Palihapitiya worked as an early top executive at Facebook from 2007 to 2011. Following his departure from Facebook, Palihapitiya founded the Social Plus Capital Partnership, through which he invested in various firms, including Yammer and Slack. In 2015, the Social Plus Capital Partnership renamed itself Social Capital. He is one of the co-hosts of the technology podcast All In. Palihapitiya is placed 2,378th on Forbes' list of billionaires 2021, with an estimated net worth of roughly $1.2 billion as of April 2021. According to him, the most important thing to discuss before discussing what is occurring now is to go down to the last few weeks of the Great Financial Crisis. He believes this because, after the Great Financial Crisis, many people were confused about what the US government and several European governments have been doing. As a result, there was a risk of a massive financial contagion at the time. As a result, the US government intervened, and the Federal Reserve began to use its balance sheet to purchase hazardous assets. The European Central Bank did it, and Japan followed suit, as did several other banks in response to government directives. Then there were the pseudoscientists and certified economists who created the term modern monetary theory. You can keep printing money and injecting it into the economy to smooth things out and generate long-term growth. It seems that several governments and their personnel were duped. Fast forward to 2022, 14 years after the idea was implemented. Governments worldwide have printed money into the economy to $30 to $35 trillion. This money should never have existed. So according to Chamath, the point to remember is that we have not necessarily been obfuscating genuine supply-demand in the market over the last 6 or 8 months. Since 2008, we have been referring to a recession or an increase in inflation. It has just accumulated in the system. We must remember that all that money must be destroyed in some way, shape, or form. If actual economic equilibrium is to be discovered, there must be a stage when we can determine the genuine demand and supply. The government has attempted to prop up things that should not have been propped up. All these people's deceptions must have been exposed over the last decade and a half. So that's the setting. Consider removing $30 trillion from the global economy. You're talking about half of the world GDP, which is currently valued at $85 trillion. It will most likely take 3 years, the systematic and deliberate removal of money, without the introduction of new money. We appear to be at the start of something that will be protracted and drawn out. This is distinct from whether or not we are in a recession. We are simply in a bear market at the moment. All those who thought this was the end of the story will be proven mistaken. According to Chamath, they were mistaken if they anticipated that the Fed hiking interest rates to 75 basis points would be the end of it. He believes it will take between 24 and 36 months. This suggests that the bottom will not be reached for another 18 months. He anticipates a lot of stormy market action. He believes we should fasten our seatbelts since the consumer price index for the next 3 to 4 months will likely be relatively low. CPI will be 7, 8 or 9% in the coming months. There are a few components that have gotten entirely out of control. The most significant is rent, which has a 3-month lag, and we plan to bring the owner's equivalent rent into the CPI. As a result, Chamath predicts that the CPI will rise. Oil is trading at $105 per barrel because Russia is attempting to destabilize the European Central Bank. They are tampering with their country's gas supplies. According to Germany's energy minister, if this occurs, it might cause a contagion similar to Lehman Brothers' failure in the energy sector. When you combine all of these factors, you have rampant runaway coats. Without genuine political changes, we cannot get back on track. Our policy on Russia and Ukraine war needs to change. Procedure on how we work or corporate or fight with China. All of these things have to get solved. In the absence of that, the prices will continue to rise. So what does the Fed do? And how does it throw away the little credibility it possesses? Those saying that we are done for right now is not enough, and it will cause them to overcorrect. There is going to be so much pressure for them to act. This only means that all roads lead to lower equity prices. There are so many areas that will cause America difficulties in the coming few months. For example, we have gotten drunk on debt as a country. One of the most prominent places we have been infusing debt is financing all these private equity leverage buyouts. Sketchy companies are teetering on insolvency at times. Here, private equity comes in and levers up the balance sheet with debt and prices it right to the edge of what is legally allowed. This is only assuming that the economy continues to grow. Suppose you suddenly have a few recessionary forces or prices go up and earnings don't. In that case, you could have a contagion in the commodity market. Facebook was one of the most intriguing canaries in the coal mine. This has much to do with economies, inflation, asset prices, equities, and technology. Everyone predicted that the market would rip open when we were closed for Juneteenth. When the markets opened the following Tuesday, the S&P 500 was up 250 basis points, and the Nasdaq was up 300 basis points. However, Facebook fell by 400 points, which is astonishing. Every other major IT company was online. When you look at who is the incremental buyer in the stock market, you may get a sense of whether prices can go up or will continue to fall. Retail buyers are the least well-informed, while institutional hedge funds are the most well-informed. Facebook is an example of a retailer-owned technology company. The case that smart money makes for owning Facebook is that it has got a highly cheap price-to-earnings ratio. They said that looking at the consumer demand, they underwrote that price to earnings is not low. Instead, E&P was just wrong. If they pass through all of these increases in inflation and their earnings expectations into Facebook. After all the calculations, it seems that the deal was more like fair value at a lower price. That is why they sold it so much on the day the market was up. Eventually, all the other stocks will also go through an earning revision in this recession. This is where Wall Street has done an abysmal job on retail. Suppose you look at the average estimates of earnings. In that case, you will be shocked to hear that Wall Street has approximated record earnings this year and is continuing to increase. He believes that Wall Street is incorrect since fewer people will have jobs, and hence fewer people will buy products. As a result, earnings will undoubtedly fall in 2023. The entire world of stocks must be reenacted at a reduced cost. It will put a lot of pressure on these IT businesses, burning cash while losing money. We handed people a large sum of money, and they acted rashly. We must now reclaim everything. I don't believe it will be as straightforward as people think. The market rose dollar for dollar due to an increase in the M2 money supply. The correlation was 92, which meant that for every $1 issued by the Fed, the stock market rose by 92 cents. It stands to reason that if the Fed removes $3 to $5 trillion in value, we must rewrite the equities markets by at least $3 to $5 trillion. Then you have to rewrite and re-baseline earnings, which will probably take another 20 or 30 minutes. Meanwhile, we keep losing our footing with China. Contemporary Amperex Technology Co., or CATL, announced a meaningful improvement in their 3.0 battery design. These guys are building batteries that go 1,000 miles. We are going to struggle to compete with such technology to these mistakes. There you have it, guys. This is why Chamath Palihapitiya believes that this market crash of 2022 may be the worst we have ever seen, and why buyers must be careful. Hope you enjoyed it. Until next time, goodbye.